If you're over 65, the day you cross that line, you became legally exempt from a whole stack of bills and taxes most people keep paying for years because the agencies that collect them will never call and tell you to stop. Being legally exempt and actually not paying are two completely different things, and the only bridge between them is knowing which form to file. Before I go any further, I need to clear up the biggest misunderstanding about a list like this because it's the reason most people who qualify never claim a single thing on it. Some of you hear senior benefits and assume this is only for someone struggling on a fixed income. So if you own a comfortable paid-off home, you tune out. Others assume it's the opposite, that this is only useful if you're wealthy enough to have a portfolio and an accountant. So, if you live mostly on Social Security, you tune out too. Both of you are wrong, and I'm going to prove it item by item. On every single one of these, I'll tell you exactly which group it helps most. So, nobody watching gets to say, this isn't for me. What I do on this channel is take the parts of the tax code and the benefit system that are written in language, built to be skimmed past, and translate them into something you can actually act on this week. Here's the one question I want you to hold on to for the next 25 minutes. How many of these can you legally stop paying starting this week? And how much of that money have you already been leaving on the table every year without knowing it? Keep a running count as we go. Most people who watch this all the way through find at least 3 that apply to them personally. Here's what's coming. 5 bills you can legally stop, lower, or freeze. Then a set of bonus moves for anyone who's built up a home or an investment account, because those can be worth more than everything else on this list combined. And I want you to stay all the way to the end because the last 2 items are things I have not covered in any other video on this channel. One is a Medicare trap that catches widows specifically, and it's costing people real money every month without a single warning attached to it. Let's start with the one hiding in plain sight in the tax code itself. Bill number 1 is your federal income tax, and specifically a deduction that didn't exist before last year. Starting with the 2025 tax year in the return, most of you filed earlier this year, or will file next spring for 2026. There is a brand new deduction in the code just for people 65 and older. It's called the Senior Bonus Deduction, and it's worth up to $6,000 per person. If you're married and you're both 65 or older, that's $12,000 combined. Here's what makes this one easy to miss. It doesn't replace anything you already had. It stacks for 2026. The regular standard deduction is $16,100 if you're single, $32,200 if you're married filing jointly. On top of that, there's a separate older provision that gives everyone 65 and up an extra $2,500 if you're single, or $1,650 per qualifying spouse if you're married. And now, on top of both of those, the new $6,000 per person bonus stacks as well. Added up for a married couple, both over 65, $32,200 plus $3,300 plus $12,000, a $47,500 deduction before a single receipt or medical bill gets counted. Compare that to a working couple under 65 who only get the base $32,200. That's a $15,300 gap built entirely out of provisions tied to your age alone. For a lot of retirees living on Social Security and a modest pension, that number alone can take your federal tax bill to zero. By the way, I've got a free step-by-step guide that walks through this and everything else in this video form by form in plain English. Links in the description if you want it. This one has an income limit. So, let me tell you exactly where it starts to shrink. It phases out once your modified adjusted gross income passes $75,000 single or $150,000 married, reducing gradually until it disappears completely at $175,000 single or $250,000 married. For the overwhelming majority of retirees watching this, that phase out never touches you. You get the whole thing. And here's the part that actually matters for you this week. This deduction is temporary. As the law stands right now, it only exists for tax years 2025 through 2028. That means it isn't a set-it-and-forget-it deduction. You need to confirm it was applied every single year it's on the books. If your tax software asks your date of birth, Make sure it's entered correctly because that's what triggers it. If someone else prepares your return, ask them directly. Did you apply the senior bonus deduction and the age 65 additional standard deduction? Both of them, not just one. Bill number 2 is your property tax. And this is where the real money tends to hide because it isn't one program. It's 3 different kinds stacked on top of each other, and almost nobody has all 3 filed. The first is the homestead exemption, and it's the gateway to everything else on this list. It knocks a chunk of your home's assessed value off the books before the county even calculates your bill. In Texas, that's $100,000 off the school portion. In Florida, it's $50,000. Every state's number is different, but in nearly every state, it's real money. And in most states, it isn't automatic. You file a 1-page form with the county, usually before a spring deadline, and in many states, it stays on file for as long as you own the home. The second is the senior or age 65 exemption, a separate application layered on top of the homestead. In Texas, every homeowner 65 or older gets an additional $10,000 off the school portion. In Florida, the senior exemption can be another $50,000 on top of the basic homestead, doubling the total. Here's where comfortable retirees wrongly assume they're excluded. They hear senior exemption and picture an income test, but in more than half the states that offer this, age is the only qualification. Texas, Florida, Georgia, Tennessee, and others don't check your income at all. The third, and the most valuable of the 3, is the assessment freeze. The moment you turn 65 and file the freeze application, the county locks in your home's taxable value at whatever it was that year. It does not matter how much your neighborhood appreciates after that. In Texas, once you file the over 65 tax ceiling, your school district tax is frozen at the actual dollar amount for that year, not the assessed value, the bill itself. Your home can double or triple in value. The bill cannot rise. This one is worth the most to the retiree sitting on a paid-off home that's appreciated for 20 years. Because that's exactly the homeowner staring down the biggest increases if they never filed. And if you're renting right now, this one is yours too. Even though it doesn't feel like it, your landlord pays that property tax bill, and every dollar of increase gets passed straight into your rent. When property taxes freeze or drop across a community, rent stops climbing the way it has been. The action here is one phone call to your county assessor's office. Ask them by name. Is the homestead exemption, the senior exemption, and the assessment freeze on file for my property? If any of them aren't, ask which form adds it and what the deadline is. Bill number 3 is the tax on your Social Security check itself, and there's more confusion around this one than almost anything else in retirement. Whether your benefit is taxed and how much comes down to one number, the IRS calls your provisional income. Roughly your other income plus half your Social Security benefit. If you're single and that combined number stays under $25,000, none of your Social Security is taxable. If you're married filing jointly, the line is $32,000. Above those thresholds, up to 50% and eventually up to 85% of your benefit can become taxable. But notice that even at the very top, 15% of your Social Security is always tax-free, no matter what. Here's a mistake I see at every income level. When people first sign up for Social Security, a form called the W-4V asks whether you want federal tax withheld automatically from every check, 10%, 12%, 22%, just to feel safe. Then, at tax time, a chunk of that comes back as a refund, and it feels like a bonus. It isn't. It's an interest-free loan you gave the federal government all year. If your senior bonus deduction and your age 65 add-on have brought your real tax bill down, that withholding is very likely too high. Now, file a new W-4V, review the actual number with your return, and stop the free loan. And there's a piece almost nobody checks. Your state may not tax any of this at all. As of 2026, 41 states plus Washington, D.C. don't tax Social Security benefits. Only a handful still do in any form: Connecticut, Minnesota, Rhode Island, Utah, and Vermont. And West Virginia just finished phasing its tax out completely. So even that one is gone as of returns filed for 2026. If you're in one of those few remaining states, look up your state's specific exemption because most of them still protect lower and middle-income retirees even where the tax technically exists on the books. Hold on to your count because bill number 4 is the one that surprises the most people once they hear the real number. Bill number 4 is your Medicare Part B premium. And this is where I want you to pay very close attention because the number most people have in their head is wrong. For 2026, the standard Part B premium is $22.90 a month, automatically deducted from your Social Security check before it ever lands in your account. That's up from $185 in 2025. It went up nearly 10% in 1 year. But here's what almost nobody is told. There's a set of programs called Medicare Savings Programs, and if your income is within the limit, your state pays that premium for you. Not reduces it, pays it every month automatically going forward. There are 3 main tiers. The most generous, called QMB, covers your premium and also wipes out most of your deductibles and co-pays. For 2026, the income limit for QMBB is around $1,350 a month for a single person, $1,824 for a couple. The next tier, SLMBB, covers just the premium with a limit around $1,616 single, $2,184 for a couple. A third tier Q I goes even higher up to about $1,816 single, $2,455 for a couple. Asset limits sit around $9,950 for an individual and $14,910 for a couple federally, though several states don't count assets at all, and California's limits run far higher than that. The income numbers here are higher than most people assume, and that's exactly why millions of people who qualify never apply. They see the word and assume it's not for them. While you're checking this, ask about one more thing in the same family: extra help, also called the low-income subsidy, which lowers what you pay for your Medicare Part D prescription drug plan, your premium, your deductible, and your co-pays. A lot of the same people who qualify for a Medicare Savings Program also qualify for extra help, and in many cases, approval for one enrolls you in the other automatically. The action is one phone call to your state Medicaid office or your local SHIP office, the State Health Insurance Assistance Program, and ask them to screen you for a Medicare Savings Program and extra help. That single call can put over $2,000 a year back in your pocket. While we're on Medicare, one more thing worth checking regardless of your income. Part A. Your hospital coverage is premium-free if you or your spouse worked and paid into the system for at least 10 years. Most people already have this, but if there's any confusion about your work record or your spouse's, it's worth confirming that's true no matter what you earn. And if your income is higher, there's a separate Medicare trap worth knowing about called IRMA, an income-related surcharge charge added to your Part B and Part D premiums. The strange part is that Medicare calculates this off your tax return from 2 years ago, not your current income. So, if you were working and earning a strong salary 2 years before you retired, and your income has since dropped, you can end up paying a surcharge based on money you're no longer making. There's a specific fix form, SSA 44. If you've had what the government calls a life-changing event, retirement, the death of a spouse, divorce, or a significant drop in income, you file the SSA 44. Show Medicare your current income and they recalculate the surcharge. It takes about 45 minutes. Almost nobody files it because almost nobody knows it exists. Bill number 5 is smaller in dollars individually, but it's still money you don't have to hand over every month. There's a federal program called Lifeline that takes up to $9.25 off your phone or internet bill each month, up to $34.2525 if you live on tribal land. And many states add their own discount on top of that. Separately, if heating or cooling your home is ever tight on the budget, there's a program called LIHEAP, the Low-Income Home Energy Assistance Program that helps pay your utility bill directly, often between $400 and $1,500 a year. depending on your state and situation. These are two separate programs applied for separately through your state's LEAP office and through Lifeline's National Verifier. But if your income qualifies you for one, it very often qualifies you for the other. None of this is glamorous money. But stack the small ones with the big ones, and the monthly number really does move. Before the bonus moves, two things that apply to almost everyone regardless of income, and they cost nothing to check. If you're a widow or widower hour and your spouse worked and paid into Social Security, you may be entitled to a survivor benefit based on their record instead of your own, and you can claim it as early as age 60. You can take the survivor benefit now and let your own benefit keep growing until it maxes out at 70. Or take your own now and switch to the higher survivor benefit later. The Social Security Administration will process whichever one you apply for. They will not walk you through which order makes you more money. If you've lost a spouse and nobody has sat down and run both numbers for you, that's the one call I'd move to the top of your list. And if your tax return is fairly simple, Social Security, a pension, maybe an IRA withdrawal, you may not need to pay someone $200 to $500 to prepare it. There's a program called TCE, Tax Counseling for the Elderly, an IRS program specifically for people 60 and older, staffed by trained certified volunteers. The largest provider is AARP Tax-Aide with thousands of sites nationwide. And you don't have to be an AARP member to use it. If your situation is genuinely complicated, a business, rental property, a complex estate, pay a professional, it's worth it. But a standard retirement return doesn't need to cost you anything. And remember those two items I promised you at the very start. We're almost there. Stay with me through this next section first because it sets up the biggest number in the entire video. Now, if you've built up some real assets, a home that's appreciated, a retirement account and investment portfolio, these next few moves are specifically for you and for the right person. They're worth more than everything I've covered so far combined. If you've lived in your home as your primary residence for at least 2 of the last 5 years, you can sell it and exclude up to $250,000 of the gain from tax. If you're single, up to $500,000 if you're married filing jointly. That's the gain. What you sold it for minus what you paid minus major improvements, not the sale price. A couple who bought a house decades ago for $70,000 that's now worth $400,000 has roughly $330,000 of gain. As a married couple, they can exclude $500,000 of it. Their federal tax bill on that sale is $0. A lot of retirees stay in a home that's grown too big or too expensive to maintain because they're afraid of a tax bill that for most people in this exact situation was never coming. There's a second window in that same low-income stretch, and it's one of the least understood moves in the tax code, a Roth conversion. Money in a traditional IRA or old 401k has never been taxed. Every dollar you pull out gets taxed as ordinary income, and at 73, the IRS forces you to start pulling it out whether you need it or not. In the years after you retire and before those required withdrawals begin, when your income is often at its lowest point in decades, you can deliberately convert some of that IRA money into a Roth IRA. Pay tax on it now at your current lower bracket, and from then on it grows completely tax-free with no required withdrawals ever attached. If you're in the 12% bracket today, and your future RMDs would push you into 22%, paying 12 cents now to avoid 22 cents later isn't a close call. The window closes the moment your income rises again. Here's a window worth knowing about if your income drops after you stop working before required withdrawals from a retirement account force it back up. For 2026, a single filer can have taxable income up to $49,450 or a married couple up to $98,900 and still pay $0 federal tax on long-term capital gains. That's taxable income after your deductions, after the standard deduction, after the age 65 add-on, after the new senior bonus. If you're in the years between retirement and your required withdrawals, and your income is genuinely low during that stretch, that's the window to sell appreciated investments without owing $1 in federal tax on the gain instead of waiting and getting pushed into a higher bracket later. And that later is worth understanding on its own because it catches people who did everything right. Once you turn 73 to 75, if you were born in 1960 or after, the IRS forces you to start withdrawing a minimum amount from a traditional IRA or old 401k every year, whether you need the money or not. That forced withdrawal counts as ordinary income,